And then the last chapter, in chapter 12, we talked about the cost of capital. Okay? Well, cost of capital is important consideration in capital budgeting, right? Everything had to be discounted using some discount rate, yeah? And the cost of capital determines that discount rate. Okay? And then we also learned that the cost of capital depends on capital structure, right? If you remember, by capital structure, we basically meant the debt-asset ratio, or what was it? Debt-equity ratio. Sorry, debt-equity ratio. So typically, we just write B over E, right? But we also learned we used three components: debt, preferred stock, and equity, right? You remember? It's a little bit too long, okay? But okay. So yeah, this is what we are talking about: the capital structure, the amount, proportion of debt, proportion of preferred stock, and the proportion of equity in the total asset or total capital of the company. Okay. So in this chapter, we're going to talk about, actually this chapter and the next chapter, chapter 14, we're going to spend some time talking about the capital structure, okay? Because capital structure determines the cost of capital for a company, right? And the cost of capital determines ultimately the value of a firm, value of a company, because using that cost of capital, we're going to discount all the future cash flow of a company, right? And come up with the present value or value of a firm. Okay, so that's how all these things are connected. Okay? All right. So capital structure refers to the mix of different securities issued by a firm. And by securities, we mean permanent short-term debt, long-term debt, preferred stock, and common equity. Okay? Well, here's one item that we haven't talked about yet: permanent short-term stock. We talked about the long-term debt like bonds, okay, and preferred stock and common equity, but we haven't mentioned the permanent short-term debt. Okay? Well, short-term debt, literally, when we say short-term, we're talking about less than a year, right, in finance. Okay? So if a company has some debt which is due within less than a year, I guess we can call it the short-term debt, right? What are the examples of short-term debts? Well, if a company has a bank loan from the bank, right? Borrowed in short-term, okay? That could be considered a short-term debt. Also, CP. What is CP? Huh? CP, what? Commercial paper, right? Commercial paper. Right? In Korean, it's called the aum, right? Excuse me. So it's basically IOU issued by a company, okay? And typical length is about 6 months to less than a year, right? So when a company needs money quickly and for a short period of time, right? Instead of issuing the long-term bond, they can issue a short-term commercial paper. It's basically the same thing, The bonds are IOUs. Commercial paper, the IOUs, the only difference is the length of maturity. Right? So they will have to pay back within a year. Right? All right, so these are the examples of short-term debt. What do we mean by permanent short-term debt? This is to distinguish this from any seasonal debt. Okay? So when a company runs the business during the entire year, depending on season, let's say you're a soft drink company, like Coca-Cola, right? Then during the summer time, obviously your sales will be great, okay? But during the winter time, your sales will be slow, right? So depending on the season, you may have larger debt or smaller debt, right? When you have a lot of cash flow, you can pay off some bank notes and commercial papers, right? And your short-term debt will go down, right? In the winter time, actually, the amount of debt may increase, right? So the company may have that kind of seasonal component in their short-term debt, right? So instead of including those seasonal components, because it changes so frequently, we don't want to include that as a capital structure, right? When we calculate the capital structure of a company, right? So ideally, we should include only permanent component of the short-term debt, which does not depend on season. But in reality, it's a little bit difficult to distinguish short-term, the seasonal component from permanent component of short-term debt. And also the short-term debt, amount of short-term debt is rather insignificant component compared to the total size of capital of a company. Okay? So in reality, what we do is we simply ignore the short-term debt component. Okay? So instead of using the short-term debt, we use the long-term debt. B stands for long-term debt, mostly bonds, right? Outstanding amount of bonds, okay? And preferred stock and common equity. Okay? So you can consider those three items as components of capital structure. Okay? All right. So the capital structure is also used interchangeably with debt to equity ratio. We also talked about debt to equity ratio. Right? What about preferred stock? Do we ignore the amount of preferred stock? What? Instead of using this three-component structure, if you're going to use simply BE, right? What do we do with this preferred stock amount? I'm sorry? It's considered equity? Can you try again? Well, yeah, there's only, I guess, 50-50, right? Yeah, the preferred stock, the name is stock, right? But for practical purpose, it's exactly the same thing as bond, right? Because, once you issue the preferred stock, you have to pay those dividend, right? Just like debt, just like bond, okay? So it's a liability instead of equity, right? So for that purpose, you can include the preferred stock as a debt, right? If you're going to calculate just B/E ratio, right? For most of the practical financial purposes, financial analysis purposes, preferred stock is considered debt. Okay? Remember that? Okay? All right, then we have target capital structure, optimal capital structure, and debt capacity, these terms. Okay? So, when we were solving problems in the previous chapter, in chapter 12 or so, we were talking about target capital structure, right? And, companies have their target capital structure. Okay? So, maybe something like 30, 10, 60, right? Is their target capital structure, 30% debt, 10% preferred stock, 60% equity, and so on, right? And they try to maintain their target capital. I guess to skip a little bit further, okay? Target capital structure should be close to optimal capital structure, right? And the concept of optimal capital structure is that's the structure or the proportion of these three components that minimizes the cost of capital, the overall cost of capital. What's the benefit of minimizing overall cost of capital? Maybe it sounds a little bit obvious question, right? But can you say exactly why you have to minimize the cost of capital? Typically we say WACC, weighted average cost of capital for a company, or overall cost of capital to a company, right? So, well, obviously minimizing the cost is a good thing, right? But when you minimize the overall cost of capital, what happens? Huh? Profit, what? Expands? Okay. Okay, yeah, that's true, right? Because profit is total revenue minus total cost. And part of the cost is the financial cost, right? Like debt servicing cost, right? Yeah. Lowers your required rate of return. Okay. Okay. Yeah. So basically the cost of capital is the same thing as required rate of return from the investors, as you know, right? Yeah, but ultimately, what's the goal of financial manager? What's the ultimate goal of financial manager? Maximizing shareholder wealth, right? So I think I mentioned it quickly a few minutes ago, right? Using the cost of capital, we're going to discount all the future cash flows of this company, right? Which means the present value of this company itself, the firm value, will be maximized. Okay? Firm value. What is the firm value? Well, it's the value of all the assets owned by this company. In other words, it's the same thing as shareholder wealth. Right? Shareholder wealth. They're all the consistent concepts, right? Firm value, right? All right, so the optimal capital structure is a structure of these components that minimizes WACC, right? And as a result, that's going to maximize the firm value, right? That's the connection, right? So ultimately, the target capital structure should be the same thing as optimal capital structure, right? If a company finds their optimal capital structure, right, that should be their target structure, right? But, well, depending on certain considerations, there may be some slight deviation, especially many times there can be some temporary or tentative deviation of their actual structure from the target structure, right? You know, textbook gives some example of starting a new business, right? When you're starting a new project, right, you may need to borrow a little bit more, right? So your the proportion of debt may increase tentatively, right? Or depending on the situation, the company may decide to increase the equity, right, by issuing more shares or selling more shares, right? So, there may be some tentative or temporary deviation of the capital structure from their target level, but, overall, in the long term, okay, the company should find their optimal capital structure and try to maintain the optimal capital structure as their target. Okay? Debt capacity is the amount of debt contained in the firm's optimal capital structure, right? So assuming this is their optimal capital structure, right? That means when they are at their best situation, right? Maximizing firm value, right? They can borrow or they can have 30% of their total asset in debt, total capital in debt, right? So that's the idea of debt capacity. Basically, how much money can this company borrow, right? Without hurting themselves, okay? Without deviating from their optimal capital structure, right? So that's the idea of debt capacity. All right? So here are some considerations, that you have to have, what the company has to have in order to come up with their target capital structure, right? Basically, we consider two risks: business risk and financial risk. Okay? And what is a risk, anyway? Again, I keep asking this same question. What is a risk? Right, uncertainty or variability, right? That's what we mean by risk in finance, right? So business risk refers to variability of a firm's operating income, which is EBIT, right? Earnings before interest and taxes. So, depending on the situation, your EBIT may fluctuate, right? The question is what factors work to what factors bring the uncertainty or variability in your operating income, right? And here are the lists of all those possible factors: the variability of sales volume, variability of selling price. What can happen? I mean, what are we talking about here? Variability of sales volume and selling price. Why would they be uncertain? In other words, who changes this volume and price? Sales volume and price. Why can't you eliminate uncertainty from the sales volume and price? Yeah? Market demand, right? More exactly, right? Yeah, so we're talking about, by these two lines, we're basically talking about demand fluctuation, right? And that is out of company's control. Company can control supply, right? Their own supply, right? But the demand is determined by consumers in the market, right? So unfortunately, you have to expect some variability in the sales volume and the price, right? Variability of costs. Why? I mean, what brings the variability of costs? What are we talking about here? We're talking about your production costs, right? What are the factors that bring this variability of cost? Friction? Inflation. Okay. Yeah, okay, right? Inflation, you're talking about general increase in the price level. Okay, that can be one factor, right? Any other? Oil price, okay, your resource price, right? Yes, oil is a very important factor, right? Just about everything comes out of oil. If you look around this room, right? You see all the plastics here. What can you make without plastics, right? All the plastics come out of oil, right? How about what you're wearing, right? Unless you're wearing 100% cotton, right? I mean, all the synthetic fabrics come out of oil, right? All kinds of chemicals, right? Come out of oil, right? So not only fuel, but oil has really pervasive impact on the, let alone fuel. Yeah? So when the oil price changes, your production costs will be impacted. Also, the labor costs is also can fluctuate, right? If labor unions have strike or demand for higher wages and so on, right? So based on that, your profit, or the operating income can change, and also profit can change, right? Market power, we're talking about market share, how much market share you have, right? And larger market share you have, what? What can you say about EBIT or business risk? The larger the market share, the larger the business risk, or less, less the business risk, right? If you are a small company in the market, you have only 1% of the market, right? Then depending on what the large companies do, right, your income will be strongly impacted, significantly impacted, right? But if you own, say, 50% of the market or 70% of the market, then you have pretty strong market influence, right? So you can control a lot of things at your, benefit. Okay? Product diversification, well, if you have a lot of diversification in what you produce, then you can minimize the risk, or you can dampen the impact from the market risk. Level and rate of growth, right? How strong your the growth rate is. Okay? What do you think about this rate of growth? If you are just a new startup company and you're growing fast, right? What do you think about the business risk? Do you have to expect higher risk or lower risk? Higher risk, right? If you're relatively small, new startup and growing fast, right? If you're a large company like GE, has a long history and already established, okay, then your operating income will be relatively stable, right? You've already established your supply chain and good established customers. So, the companies like GE are considered income stock, right? Because they pay the dividend regularly, right? But their growth is not that fast. Okay? When you pay the dividend regularly, that means your growth is slow, right? Do you understand the relationship between dividend? If the company pays 100% of their income, right, as dividend, what will be the growth rate? Will be 0, right? Okay? So, that's the idea, right? the company which pays a lot of dividend has a slower growth rate, right? In order to grow fast, okay, you have to retain a lot of your income, your profit, right? And reinvest, right? Okay, so that's what we mean by level and rate of growth, okay? All right. Degree of operating leverage, DOL, okay. Degree of operating leverage, actually this is the topic of next chapter, okay? We're going to talk about it exactly in the next chapter. DOL is percentage change in EBIT over percentage change in sales. Okay? So what is it? What does it measure? Well, it measures for certain amount of increase in sales, what happens to your operating income, the relationship between your sales and operating income, right? And if you actually calculate this, right, this comes out to be 1 minus fixed costs divided by profits. Fixed costs divided by profits. So the company, a business with larger fixed costs compared to the profit, will have what? Lower, I'm sorry, can't be, yeah, one plus, yeah. 1 plus fixed costs divided by profits, right? Yeah, so the larger the fixed cost, the larger the degree of operating leverage, okay? And, well, we're going to talk about it exactly in the next chapter to understand why. Okay? What is fixed cost? You know the difference between fixed cost and variable cost?
The cost you have to pay whether you produce or not.
Okay. In other words, fixed cost is the component of the cost which is not related to, huh? Yes, your output, right? Units of output, right? Variable cost is the portion of the cost that has positive relation to your output, okay? All right, so business risk can be systematic or unsystematic. Unsystematic risk can be reduced by diversification. What's the difference between systematic and unsystematic risk? Well, what's the definition of systematic and unsystematic risk? Huh? Market risk, okay, yes, it is related to the market, right? So, systematic risk depends on what happens to the market, right? As the overall market risk increases, the systematic risk will increase, right? Unsystematic risk is, you can say, firm-specific risk, right, for individual company. So in that case, you can, by having more or a variety of companies in your investment, you can reduce unsystematic risk. Okay? Okay, that's the idea. Pretty familiar. Okay. Financial risk. All right, so this is our, I guess, major topic today, the financial risk. Okay? Financial risk has to do with leverage. Okay? What is leverage? In one word, what is leverage? Debt, yes, debt, right? So, when a company borrows more, that increases the risk, right? Risk of insolvency, right? Because their debt servicing cost rises, right? So when the business is good, when they're earning good income, right, then will be no problem, right? But when the business slows down, economy goes into a recession, right? Their sales goes down, then they may not have enough. They may not generate enough sales income to handle their debt servicing cost. Okay? All right, so that's the idea of financial risk. An increase in financial leverage causes EPS to change, earnings per share to change. Okay? And the thing is, EPS will change at a rate which is greater than the change in operating income. Okay? Well, what are we talking about here? Let's use this table first, okay, to understand what we're trying to talk about. Okay? This is table 13.1 in your textbook, okay, in case you don't have your note with you. Okay? So we have 3 examples here. Okay? And in the first case, in the first column, the leverage factor is 0%. In other words, there is no debt. This company is 100% equity and no debt, right? The second column is 40% debt. The last column is 80% debt case. Okay? And all 3 companies have $1 million total asset. Okay? And of course, the total amount of debt is 0, 400,000, 800,000, right? So that means, again, forget about preferred stock. Let's just say this is between debt and equity, right? So preferred stock is included in debt, let's say, right? Then that means in the first case we have $1 million equity, second case $600,000 equity, and so on, right? So total liabilities and equities will be the same. I mean it's all 1 million in all 3 cases. Okay? And let's say EBIT are the same as well, right? All 3 companies have $200,000 operating income, right? The interest rate, right after EBIT, you have to subtract interest payments, because EBIT is earnings before interest and taxes, right? So after that, you subtract the interest payment, right? And interest payment will be if you assume 10% interest rate, that will be 40,000, 80,000, making the earnings before tax EBT, right? 200,000, 160, 120, right? And income tax, let's say tax rate is 40%, right? And you come up with this. Well, the benefit of having larger debt is you can reduce the taxes, right? Because interest payment is tax deductible, right? So that's why we have $80,000 tax in the first case, $64,000 in the second case, and only $48,000 tax in the third case. Okay? So that means earnings after tax, 120, 96,000, and 72,000. Okay? So when you calculate return on equity, right, that is EAT divided by total equity. Equity is here. 1,600,000 and 200,000, right? Look at the difference. Return on equity, ROE, right? Borrowing more increases return on equity, right? So if you have 80% of your total asset in debt, right, then your ROE will be 3 times the 100% equity case, right? That will look good to your investors, right? Stockholders. Ultimately, what they're looking for is return on equity, right? How much money they get back when they invest in equity, right? Well, however, there is a downside. There is another story. Oops. Here, right? The risk also increases with the return on equity, right? So here, the expected when something happens and EBIT goes down because of, say, slow economy, right? Economy went into a recession, right? And the EBIT went down from 200,000 to 150,000. That is 25% reduction in EBIT, right? Then when you go through all the numbers, the return on equity comes out to be 9% in the first case, 11% in the second case, 21% in the third case. Okay? So the third part, the last part, assumes a little more severe, right? Economic depression, let's say, right? So suppose the EBIT went down by 60%, right? Then literally all the return on equity will be wiped out because of your debt servicing cost, right? You have to understand what happened here, right? The EBIT, because of the 60% decrease in the earnings operating income, right? Your operating income is only 80,000, but interest payment is exactly 80,000, right? So your EAT, earnings after taxes, is 0, meaning your return on equity will be 0, right? So that's a return on equity, ROE, right? Based on EAT, right? So let's assume 100,000 shares outstanding. Right? Then you divide the EAT by the number of shares to calculate what? What are we calculating? Divide EAT by number of shares. EAT divided by number of shares outstanding. What are we doing? EPS, earnings per share, right? Earnings per share, right? So EPS will be $1.20, $1.20, 96 cents, and 72 cents, right? In the first case, right here, right? You divide 120 by 100,000, 1.2, 0.96, 0.72, right? In the second case, it will be 0.9, 0.66, and 0.42. In the last case, 0.848, sorry, 0.24, and 0, okay? 0.0, right? So the decline in the first case is 60%. Well, that's understandable because in the first case there was no debt. It was 100% equity, right? And earnings, EBIT, went down by 60%, right? So EPS goes down by 60%. In the second case, if you have 40% debt in your capital structure, right? If the earning goes down by 60%, or operating income goes down by 60%, your EPS will go down by 75%. From 96 cents to 24 cents, that's 75%. Okay? If your capital structure includes 80% debt, right? When the operating income declines by 60%, right? What? What is that? That's 100% decline in EPS, right? That's what we're talking about here. Right? So, an increase in financial leverage causes a firm's EPS to change at a rate greater than the change in operating income, EBIT, right? So change in operating income will be magnified, right, when you have leverage. Right? You understand the meaning of leverage, right? Leverage. Okay. This length, this is called leverage. Okay? So when you have longer leverage, when you have only short leverage here, like here, right, it requires a lot of force to lift this weight, right? But when you have longer leverage, it requires only small force to lift this weight, right? That's the idea of leverage, okay? So when you have debt, what happens? When you have a lot of debt, you can lift, you can increase your ROE quickly, return on equity, right? Will increase quickly, right? In other words, you can make a lot of profit, right? ROE is the profit ratio, a measure of profit ratio, right? But the problem is risk is also great. Risk. Okay? All right? All right, so here's another statement about the financial leverage. Firms employ financial leverage to increase returns to common stockholders, in other words, ROE, right, return on equity. Okay? But these increased returns are achieved at the expense of increased risk. Okay? All right, so here's another way of looking at it. Okay? Here's the blue line. Blue line is the case with all equity, 100% equity capital, right? No debt. Right? Then, as your EBIT increases, your EPS will go up at a certain rate, right? The slope, right? And if your EBIT goes down, EPS goes down. In the worst case, if the EBIT goes to zero, your EPS will be zero, right? Because there is no debt. There is no debt servicing cost, right? However, if you have some debt, right, this is the case with the use of fixed cost debt financing, right? We have steeper slope, which means for same amount of increase in EBIT, right, you will have a lot larger increase in EPS, right? You see that, right? It's easy to increase return on equity when you increase your operating incomes by a certain amount, right? But what happens when the EBIT goes down? At this point, well, the point is when the EBIT moves the other way, right, from here to here, right, then EPS goes down faster. And not only that, at this point, EPS becomes negative. Why does it become negative? I'm sorry, what? Cost of debt, right? Debt servicing cost, right? So, yeah, it is a risk, right? Borrowing involves risk, right? That's what we are talking about here, financial risk. Right? All right, here we have interesting theory here. It's called the MM model. Modigliani and Miller, Franco Modigliani and Merton Miller, right? And these guys, about 50-some years ago, okay, introduced a theory. Okay? And their conclusion is pretty simple. They have two propositions, right? Proposition 1 is a firm's value is determined by its real assets, not by the securities it issues. In other words, the market value of a firm is independent of its capital structure. That's a problem, isn't it? Because a few minutes ago, I just told you about the optimal capital structure, right? There is something called the optimal capital structure, which minimizes the cost of capital, right? And that means that's the way you can maximize firm's value, right? But Modigliani and Miller, by the way, they have, well, actually Merton Miller received the Nobel Prize in 1990. Unfortunately, Modigliani was dead at that time, okay? So he was not among the recipients, okay? So the theory is there is no such thing as optimal capital structure, right? Capital structure doesn't matter, right? Firm's value has nothing to do with the capital structure. That's the proposition 1, okay? And proposition 2, I guess that explains the proposition 1. The reason is any increase in expected return is exactly offset by an increase in risk and therefore in shareholders' required rate of return. Well, this requires some explanation, right? So their theory assumes a perfect capital market. No taxes, no bankruptcy costs, no agency costs. Bankruptcy costs, agency costs, these things are called the transaction costs. Okay? So, more exactly, if you read the chapter, you can read it, you can find it more exactly, right? But this MM theory requires a lot of assumptions. Okay? No transaction costs. In other words, when you buy and sell the stocks, there's no fee, right? That's the assumption. When you buy and sell any stocks or securities, there is no fee, transaction cost or fee. Okay? Perfect information. Information. Right? Everybody knows how many stocks and bonds are available, right? And there is sufficient demand for stocks and bonds, right? So basically, perfect market. Right? And all investors can borrow and or lend at the same rate. Okay? So interest rate is there is only one interest rate in the market. Okay? So everybody can borrow and lend at the same interest rate, right? Which is quite unrealistic, right? So, there's, did I tell you about these assumptions? Economists make a lot of assumptions. Okay? Okay? Let's assume that we had an opener, something like that, right? So, yeah, it is based on a lot of assumptions. Okay? Assuming all these perfect conditions, right? They say if the leverage increases, the cost of equity increases to exactly offset the benefits of more debt financing, leaving the cost of capital constant. Okay? And for this, they use arbitrage concept, or let's say example, arbitrage. What is arbitrage? Okay. I'm sorry? Making profit without risk. Okay. All right. Okay. Arbitrage. Yeah. Yeah, it can mean many different things. Let's say this Seoul city has cigarette tax, okay? But outside Seoul city there is no cigarette tax, right? So obviously the price of cigarette will be higher in Seoul and cheaper in outside, right? Then there will be some guys that will buy cigarette from outside and bring it in here to Seoul city to sell, right? To make the profit, right? That's the kind of arbitrage transaction, right? Arbitrage that Merton and Miller the Modigliani and Miller are talking about here is, let's say there's a firm A and B, company A and B, right? And this is the company A is leveraged, B is unleveraged. In other words, company B has no debt, right? 100% equity, right? Company A has some debt, right? Well, I guess the story starts from both are unleveraged, but company A just borrowed some money to increase the return on equity, right? To increase the profit, right? They borrowed money, right? Then what's going to happen is their stock price will go up. Why? The price of company A stock will go up. Can you explain that process? A simple idea, right? Yeah.
The total company's assets / equity will increase, but the equity will stay the same. Therefore, there's more.
Okay. You're saying.
In the company per share.
Oh, I see. Right. So, yeah, instead of assuming the same level of asset, you're saying, yeah, the total asset value goes up, right? Yeah, okay, well, that can happen. But, basically, the reason why the company would borrow, according to the discussion that we have been having today, right, is to increase profit, return on equity, right? And the EAT goes up, right? And as a result, EPS goes up, right? Earnings per share goes up, right? When the earnings per share increases, stock price goes up, right? That's the typical process, right? So stock price goes up. Then what's going to happen, according to Modigliani and Miller, is the investors are smart. They have perfect information, right? They know everything, right? So they know that while their stock price goes up because the EPS went up, the risk also went up for company A, right? And what that means is this company B's stock, I mean, the price is still low, right? And they're going to sell this stock when the price went up, right? They're going to sell this stock and purchase company B's stock. So the story is company A and B were identical in the beginning, right? And company A suddenly borrowed money, right? And that increases the risk for the company. When the risk increases, cost of equity goes up. What is cost of equity, right? That's the required return on their equity, right? The investors require higher rate of return because the company is now riskier, right? So what's going to happen? When the price goes up, they sell it and use that money to purchase this stock, right? So what happens? What's going to happen to the stock price here and here? When the investors sell this and buy this, right? This price will come down and this price will go up. Eventually, they will be equal, right? That's the idea of arbitrage, but that the Modigliani and Miller are talking about. Okay? So that's the idea. The cost of equity increases to exactly offset the benefits of more debt financing, leaving the cost of capital constant. Okay? And market value of the firm is independent of the firm's capital structure. That's the proposition 1, right? According to here. The firm's value is determined by the total amount of real assets, the composition, proportion of debt and equity doesn't matter, right? That's the idea, right? All right, so here's one example. Let's see. I think we'll have enough time. All right. There are 2 cases that we're going to talk about. The first case is without the corporate income tax. Let's assume there is no corporate income tax, right? And suppose the firm takes on some debt, and as a consequence, the firm's stock price rises, just like here. Okay? Then investors will sell the overpriced stocks. I mean, overpriced. So the assumption is investors know that there is nothing substantial happened to this company A. Just because they have taken on more debt, their stock price went up, right? So that's why they think it's going to be, it is overpriced. Okay? So they're going to sell this overpriced stock and purchase the other stock instead, which will make the stock price of the first firm back to the initial level, or the prices of both stocks equal, right? Okay, so here, a little more detailed here. Let's say there are 2 companies, okay? This, instead of A and B, now we're going to say unlevered stock versus levered stock, right? Levered company, okay? So value of the company U is D divided by KE. D is dividend, okay? So remind yourself of this perpetuity idea. Perpetuity. Okay? Suppose a company pays dividend, the same amount of dividend forever. Okay? What is the value of this company, or value of the stock, right? That will be, so present value or price of that stock will be D divided by discount rate. Just like the perpetuity case. Perpetuity case is this bond pays certain amount of interest forever, right? And what will be the price of or present value of this perpetuity? It's going to be amount of interest divided by the interest rate, right? Discount rate, right? Let's say that's KD, right? Discount rate for debt, right? So, company U has no debt, only equity, 100% equity. So their value is dividend divided by cost of equity, KE. Right? Company L has both equity and debt, right? So their value is their dividend divided by cost of equity plus interest payment divided by cost of debt, right? Yeah, dividend paid to the company L's stockholders are reduced by the amount of I paid on the debt, right? I guess if you look at this, it'll be a little bit easier to understand. So we have a company U and L here, okay? And let's assume both companies have the same amount of operating income, right? But company L has some debt. Let's say they borrowed. Well, their interest payment is 100, right? So the income available to stockholders, in the first case, it's 100% dividend. That's 1,000, right? In the second case, the total amount of dividend available is 900 because 100 is used to pay the interest, right? But the total amount of interest payment and the debt payment, dividend, the debt payment and dividend payment will be equal at 1,000, right? And let's assume that the cost of debt is 5%, okay? And so the market value of debt, which is interest payment divided by that 5%, in other words, 100 divided by 0.05, that will be 2,000. Do you understand this part? Okay. Using this idea, okay. If you receive certain amount every period forever, right? The total value of that instrument is the interest payment divided by the interest rate or discount rate, right? So here the cost of debt is 5%, 0.05, right? So if you divide 100 by 0.05, you get 2,000, right? That's the value of debt for that company. Of course, for company U, there is no debt. All right? Well, the required rate of return on equity, 10%. Okay? And then the market value of equity will be dividend divided by that 10%, which will be 10,000. Okay? And so the total value of the firm is the value of equity plus value of debt will be exactly 10,000. In the second case, the required rate of return on equity is 11.25%. You have to understand how this the rate is calculated. Okay? Any idea? Think about it. Just look at this column and how they think about how they came up with the 11.25% for the required rate of return on equity. It's a little bit confusing because chapter seems to have very almost no explanation. Right? So you can understand it this way. Okay? Assuming the market value of the company L is still 10,000, right? Then 10,000, well, based on this expression, right? Market value of the company is value of equity plus value of debt, which is this one plus this one, right? So based on that, we can write it this way. Okay? It is 100 divided by 0.05 plus 900 divided by KE. Okay? So amount of interest payment divided by cost of debt, amount of equity divided by cost of equity, right? If you set it this way, then you can calculate KE comes out to be 0.1125, 11.25%. Okay? But that seems a little bit circular argument, okay? Because the whole point of this chapter is this. I mean, at the end of the whole thing, the two market values of company A and company B should be the same, right? So assuming this seems to be a little bit circular. I mean, in order to, based on this, we derive this rate, right? So we have to come up with another way. Eh? And let me just write it down. We don't have much time, so let me just write it down and I'll let you think about it, yes, before next class. Okay, okay, so think about KA. KA is WACC, weighted average cost of capital, can be calculated as B divided by B plus E times KD, cost of debt, plus E, B plus E times KE. If you have cost of debt and cost of equity, you can simply multiply by the percentage of debt over the entire, this is the ratio of debt, proportion of the debt, right? This is the proportion of equity, right? So this is the weighted average cost of capital, right? And based on that, we can rearrange KE, right? We can rearrange for KE is KA B plus E minus KD, okay, B plus E, B plus E. I'll just write it down, make sure, I'll let you verify that. And finally, we arrive to KA times 1 plus B over E minus KD B over E. Okay? And from here, we arrive to the final arrangement of KA plus KA minus KD B plus B divided by E. Right? All right? So based on this equation, I use 0.1, 10% plus 0.1 minus 0.05 times 2,000 over 8,000 0.1125. Okay. All right, so we're going to pick it up next class and go over this again. But why don't you just think about it? Maybe there is an easier way to prove this, right? Just think about it and I'll let you know. Okay, I'll see you next Tuesday.